Hey there, everyone. Welcome to our Friday show. This is Chart This with Dave Keller. It's Friday, November 15th, and I'm your host, Dave Keller. Pleasure to join you here from a sunny and beautiful Redmond, Washington. The challenge with the Seattle area, as I'm sure many Canadians will attest, we're so far north here in the continental U.S., we're practically Canada, and the summer days are very long and wonderful. The winter days are very short, and for us here in Seattle, quite wet. So having a nice sort of sunny break from the torrential, or I guess consistent rain here in the Seattle area. But overall, hope you guys are all well wherever you're tuning in from. We do live stream this show on all the social platforms that we use, LinkedIn, X, Facebook, and YouTube, and appreciate you tuning in so much. Thanks so much, as always, for all the thoughtful questions. And this is an all-mailbag edition, trying to address some of the great questions we've received over the last week or two. Keep them coming, whatever platform you're watching this on, particularly if you're watching the replay on YouTube. Make sure that you drop a comment with any questions that you have. The mailbag can always use some more questions. And in future episodes, I'd love to answer one of your questions during the broadcast. So the way this is going to go is I'll bring up, we got 5 questions queued up for you. Let's get to question number 1. Dave, is the MACD indicator a leading indicator or a lagging indicator? What about RSI? I get a lot of questions about leading versus lagging indicators, just how to use different technical indicators. Best way to show the relationship between these is to use an example. So if we were looking at a chart of Ford and the chart on the top, about a year and a half daily price action, 50 and 200-day moving average. RSI is the next panel down, and then the bottom panel is the MACD indicator. And you're asking about those two indicators at the bottom. So the technical toolkit, as is implied by your question, I think has different types of indicators. And there's actually quite a different types, many of which we don't get to. I would say volume-based indicators are kind of their own thing. I would say, sentiment kind of indicators are probably their own thing. I would say price. What would I call those? Like price level indicators or support and resistance indicators like Fibonacci retracements, Gann. I would say Elliott Wave are kind of in their own bucket about trying to set a framework looking at price relationships. But then in terms of the core technical indicators that many would use, I would say there's a big difference generally between leading indicators and lagging indicators. Leading indicators try to anticipate that a turn is coming. They try to give you an early warning of a heads up of some potential change in character. Lagging indicators are not trying to anticipate the future. They're just trying to confirm something has happened. And before you think, well, an indicator's lagging, so why is it helpful? I have seen so many traders, and I've worked with successful investors and some unsuccessful ones too. And when I've worked with them, I have seen so many that hold on to things way past their expiration date according to the chart, right? They get a good signal, they buy a position, they hold it, the chart changes, the signal's triggered, an uptrend becomes a downtrend, and they still hold it for whatever behavioral reason or whatever it is. And so I think lagging indicators are fantastic in that they force you to admit that you're wrong. And that is what is so difficult for investors, for traders, for human beings, is to openly admit to yourself and those around you, I was wrong, I'm going to fix it. And it takes courage and conviction to take action on those sorts of signals. And that's why I think lagging indicators are so meaningful. If you're holding a bunch of stocks or ETFs and they start to, give sell signals from lagging indicators, you better revisit them. At the very least, revisit that thesis and see if you still want to hold those things. So that's a long-winded way of saying there are leading and lagging indicators. I use a combination. I think they both have a very important place in your toolkit. What you will notice if you look at it's not Facebook. It's actually Ford Motor Company, as we all know. If you look in August of 2023, stock in a downtrend breaks below the 200-day moving average. RSI becomes oversold. RSI comes out of the oversold range third week in August. Soon after, the MACD indicator gives a buy signal. So the RSI becoming oversold, I would argue, is probably your first warning that we may be getting toward the end of the move. The RSI coming out of the oversold region is what tells you the momentum is really changing. The MACD indicator giving a buy signal is sort of the confirmation that the trend is now most likely positive. See a similar relationship here in late October. RSI becomes oversold as we aggressively sell off. RSI comes out of that oversold region right at the beginning of November. MACD gives a buy signal about a week or two later when the trend has come up enough to finally give that. And you'll see a same sort of thing here at the lows in July into early August. RSI oversold, RSI no longer oversold, MACD a buy signal. Now, again, going back to my earlier point, I don't think that means you can just ignore the MACD indicator and just use RSI, because obviously that's all you need. I think that combination of those two and the way that I described is kind of how a bottom should form. And I'm okay missing. I don't need to bottom tick this chart and buy at the low in late October. I'm going to feel like it's a huge failure. I'm happy buying a little bit later and having more confidence or more conviction that the bottom is probably in, and then the uptrend is now progressing. And that's why using a leading indicator like RSI and a lagging indicator like MACD, and not that those are the only two out there, there are many in both categories. I would say combining them two in a thoughtful and deliberate way can be very, very helpful. I hope that helps answer your question about leading versus lagging indicators. Great question. And by the way, for my Market Misbehavior Premium members, that is what we talk a lot about, is looking at examples. I get a lot of questions like that, and we talk about the signals and how to relate them. So if that's something you want to dig into more and you want help doing so, marketmisbehavior.premium, marketmisbehavior.com/premium. That's the URL, David. All right. Next question, Dave. CLS looks very strong. Nice gap up, but my concern is it's moving too far away from the 21 and 50-day moving averages. Do you think it's better, or don't you think it's better to wait for a pullback or consolidation for an entry? Really interesting chart. This is not one I'd looked at too often. This is CLS, which is a technology stock. It's in a group called Electrical Components. CLS has had a pretty good Q4 so far, obviously rallying and breaking out. And to your point in your question, right, it sort of had a nice breakout above resistance. I think the high in July and October, that breakout is pretty meaningful. And then we sort of continued higher. That breakout happened actually in late October before the elections, right? So something that was actually already progressing higher. Now what's happened is you've had a bit of a pullback from around 88 down to around 78. And as of today, here on Friday, we're pushing up a little bit higher, up about 2% today. So yeah, when a stock gets really far away from moving average resistance, you can think of that as a contrarian sell signal, right? Generally speaking, as a contrarian. I would think of that more on a swing trading time frame, though, right? If you think about the fact that a chart like CLS is going from the lower right to the lower left to the upper right over a period of time, it's not just going in a straight line. It sort of has those impulse moves and pullbacks, right? The rallies and the pullbacks. And if you're trying to understand where we're at in that rally upswing versus downswing trajectory, even though the longer term trend is up, maybe if we're at the upper end of that channel, I don't want to be buying. I might want to wait till we've pulled back a little bit so that I can just, again, if I buy all the way up, I'm probably going to have a pretty, fair allocation. But if I buy at every peak versus if I buy at every swing low, I'm going to have a much different return at the end of it, right? If I can bring my cost basis down a little bit on each one of those entry points and just optimize it a little bit, just a little bit, that probably gets me a much better return. It definitely will. That's how the math works out. So the idea of looking for stocks that are too overextended and looking for some sort of pullback is a tried and true approach to technical analysis and really to investing. This is what we would do working with a lot of money managers, trying to just optimize entry and exit points and just, focusing not just, I like this company, let's buy some of it, versus I like the company, I like the story. When's the right time to be adding positions? When's the wrong time to be adding positions? And just improving the entry points, improving the cost basis for your position over time. If you can do it a little bit every time, it starts to turn into a real improvement to your alpha or your performance as an investor. So there are technical indicators. One that you can use, like on the Stock Charts platform, which I know very well. The PPO indicator is based on a difference from an exponential moving average. In Stock Charts ACP, there's actually an indicator. It's called like distance from moving average or something like that. I'm sorry, I don't remember the name off the top of my head, but there's an indicator that literally shows how far are we, what percent are we away from a moving average. You can also scan for stocks that are a certain percent above their moving average, maybe put those on a watch list and look for pullbacks as a time to go into it. that's how we think about the market on different timeframes. Again, CLS, I would argue, undeniably still in a primary uptrend of higher highs and higher lows. The moving averages are sloping upwards, but whether it's the right moment to actually add to a position, that's where we're waiting for some actionable pullbacks. That is an approach that a lot of institutions use, and I would say a lot of individuals could probably use as well. Great question. Next one, I was watching your video on YouTube about the QQQ, the NASDAQ 100. What are your thoughts about SQQQ? Right. So if you're really skeptical about the Qs going higher and you want to start betting against them, what do you do? So there are a number of levers you can pull as an individual investor in 2024, probably more than ever. I mean, you can use options, you can use funds, bearish funds. You could short the Qs if that's something you want to do or you're comfortable doing. And obviously you can use margin all along the way. So if you want to bet and use ETF or ETF-like products to bet against the QQQ, there are three that come to mind, right? The PSQ is a pro-shores like single short QQQ, which means if the Qs are up 1% on a random day, the PSQ should be down 1% on a given day, or right about the same amount, but in the opposite direction. The QID is an ultra short QQQ, so it's double the downside exposure. And then you have the one you asked about, which is SQQ, which is basically a triple short Q. So if you think the Qs are going down, there are ways you can play that using these three products that I shared with you. In the SQQQ, the benefit is if the market does go down, if the Qs do go down, you stand to gain quite a bit because you're basically triple leverage the downside in the Qs. Two things I will tell you, though, about using these what are called inverse leveraged ETFs. Number one, remember that their calculations are meant to match the percent moves in the underlying security on a single day. So the SQQQ uses derivatives and other things. It's not like they actually go out and short the Qs and then give you the money back or something. They literally use interest rate derivatives and swaps and things like that to recreate an artificial triple short QQQ instrument, and that's what they're using. So it is meant to match the returns, triple the returns the opposite way for one particular trading day, which means over time, those percentages won't be the same, right? Which meaning over the year, if the Qs are up like 20% year to date, I don't think the ultra short QQQ or the ultra pro short QQQ are not going to be down triple that. They're not going to be down exactly 60% because that's not necessarily how the math might work out. It could be something like that, but it's not going to be exact. So a lot of times I find if you hold them over a longer period of time, the returns don't make sense as much because that's not what they were designed to do. These instruments were really designed to be used in very short-term applications that were meant to be really used during the trading day as a way to get exposure, from one, in the middle of the day, not using it for months or even years. But I've seen people try to do that. So number one, just remember what the calculations actually are. So over time, the returns might not match what you would think because it's using the individual day's returns to calculate it. The other thing I would say is remember that if you're shorting anything, if you're shorting a stock, it has been shown to be a very profitable strategy on very short-term timeframes. And again, we're at a period where the equity markets have been in a primary uptrend now for a number of years, which means holding short ETFs for a prolonged period of time has been a fantastic way to lose money consistently because markets keep going up. And so these leveraged inverse ETFs keep going down generally in price terms. So holding short positions over a longer period of time usually does not work out. As a matter of fact, the longer you calculate the time, the returns, it has never worked, right? I mean, over multiple years, short positions never really play out because the market, generally speaking, goes up over time. And there could be periods where the market goes down for sure. But I always tell if someone says they have like an inverse ETF as like a position that they think of it as like something they're holding over a period of time, I'm like, hey, that probably isn't going to work. I mean, I don't know what's going to happen tomorrow, but that usually doesn't work because the markets, generally speaking, tend to go up. So playing the short side on a tactical time frame can be very helpful. So it was a long-winded way of answering your question about the SQQQ. Before we continue on, I have a couple more questions that I want to answer, but I do want to let you know we have a free webcast coming up next week on Tuesday, November 19th, called From Patterns to Profits, the 3-Step Approach to Technical Analysis. When I teach my premium members, we have a series of virtual courses that I provide to them as part of their membership. And when we talk about signals, we talk about any technical signal as having three distinct stages or three pieces to it, three steps. And I find a lot of people think of technical indicators or technical price patterns as a moment, right? The pattern, the trigger, it triggered, that's it, just go make the trade. And I would say what I've learned is that you think of it in three different steps. And I find that if you use these three steps, what I think and what I hope it will do is it'll basically improve your hit rate. Have you, generally have more more success using technical analysis because you're weeding out some of the false signals and putting your money behind the successful signals. If you want to learn more about that, free event coming up next Tuesday, you can sign up at marketmisbehavior.com/3 steps, or just scan the QR code that I'm providing on the screen right now. All right, let's get to question number 4. Dave, why do you think there is no 60/40 ETF, such as the VBINX, in mutual funds? Thanks for asking about what are called balanced funds, right? And again, in my Fidelity days, I worked with some of the portfolio managers that ran the balanced funds. The idea is in one mutual fund, you get 60% stocks and 40% bonds, or some allocation, whatever the mandate of the fund is. And the Vanguard fund that you asked about, VBINX, essentially does that. It's basically doing a 60/40 portfolio, 60% in stocks, 40% in bonds. And I did some digging on this. So it made me think of it. And I'll tell you, the short answer is anytime financial institutions aren't providing you a product which you think they should, it's usually because they don't think they can make money with it. And that would be my initial, that having worked at a big institution and worked with people that work at a lot of big institutions, that is usually a pretty good motivator of what new products you put out. You put out products that you think are going to help the firm make money. And so if they don't think they can make money with balanced ETFs, then they're probably not going to do it. So there really aren't any ETFs that I found in the US necessarily that are exactly like this. In Canada, there actually are. So if you're a Canadian investor, a couple, if you just search for, Canadian balanced funds, you'll find some that even hold U.S. stocks, but are listed in Canada. So for U.S. investors, probably not practical to want to get those. Having said that, there are a couple that I would point you to, and I just did a little bit of digging and did find some. I mean, the kicker is it's so easy to recreate this by having using the S&P or some core equity fund and the ag or some core bond fund and allocating your portfolio. That's 2 trades instead of 1. I mean, I don't know if that saves you a ton of time. And that's what I do in my own portfolios. If I want some sort of balanced exposure, I use ETFs that I think are good representations of those different asset classes. Then I use my own capabilities, which are not too hard to do it. Having said that, there's a Capital Group one, which is linked to the American fund, CGBL, which has a balanced ETF that's pretty close to the fund that you asked about. AOR, not AOR bracket. AOR is an iShares Core Growth Allocation ETF. A little bit different. That's a little more actively managed from what I could see. And then NTSX is another one. This is a wisdom tree one. Now, this actually is a balanced fund that uses some leverage. So it actually does some leverage returns to try to improve the returns over time. But if you looked on these charts, all 3 that I showed you, just don't pay too much attention to the relative strength, because all of those, anything that's allocated away from mega cap equities has underperformed in the last 12 months for sure, right? Because equities have been so strong and the biggest names have been the strongest. So any sort of balanced fund has not had a particularly good 2024 if you compare the returns to something like the S&P or the NASDAQ. However, they obviously provide diversification. They provide more of a safe haven, more of a balanced approach. And for some investors, that's where you're looking for based on your risk appetite. So there are products out there. And again, as always, not a recommendation that you buy or sell any of those particular tickers. And as always, I would encourage you to do due diligence. Think about fees, think about spreads, think about liquidity, think about holdings, concentration, all the things I think you should do to really assess an ETF, particularly a new one that you're not as familiar with. But thanks for asking about balanced funds. I'm surprised, actually, as I looked into it, I was like, boy, there really aren't a lot of balanced ETFs. And again, short answer, I think it's easy enough to recreate that in a brokerage account using 2 ETFs. And I think that's why fund companies just don't see it as being a big growth area, I would imagine. Final question, then we'll wrap up the week here. Would you set a stop at the most recent price where RSI dropped below 40, or is there a way to just use RSI below 40 as a trigger? And this is a question I really appreciate. It came after the video that I posted in the last week looking at RSI and RSI phases. Actually, I think I did this Monday for Stock Charts TV, if I remember right. I did an episode on RSI in different phases and basically the extreme overbought conditions that I noted on charts like GoDaddy. This actually gets back to, in some ways, the first question we had today, or second question about CLS, thinking about stocks that were very far away from moving averages. What you'll find is if you compare that first chart with some of the charts we're looking at like now with GoDaddy, look at when the prices are very far away from their moving averages. You'll find that's when they become overbought. And when they become extremely overbought is when they're arguably quite overextended away from their moving averages. And that kind of makes sense, right? If the momentum is excessive to the upside, we're probably going to get pretty far away from the moving averages. So I would say similar sort of answer to what I said about CLS. I think, when the RSI gets above a certain level, waiting for pullbacks for the RSI to get down to around 40 is a pretty good approach. And so I would say, if I have a group of stocks that I like as long-term charts, I feel they're overextended and I'm looking for an actionable entry point, the types of things I would look for would be stocks pulling back to an ascending 50-day moving average, the RSI pulling back to around 40. The cursor happens to be at one of those moments for GoDaddy here in early September, where we made a new 52-week high. We pulled back to an ascending 50-day moving average. The RSI is around 40. My earlier comments talked about optimizing entry points. That's the kind of thing I would be looking for. But then that also, I think, provides a pretty good stop, because if the 50-day does not hold, if the RSI does not hold at 40, that tells me maybe we're in a different phase then. Okay, maybe this isn't an actionable pullback, and I want to move on and go to something else. Justin Mamus, who's a famous technical analyst, no longer with us, unfortunately, for a number of years. But, he used to say, if a stock doesn't do what you expect it to do, sell it. And the point of it is, if you have a particular thing, if I'm seeing this configuration, I say, pull back within an uptrend, RSI around 40, this seems like a good entry point. If it doesn't do that, then move on, right? Move on to something else. And I think that's one of the benefits of being an equity or ETF investor is you always have a lot of other levers you can pull. So if a chart isn't doing what you think it should, find a new chart. Folks, that'll do it for today, and that'll do it for this week here on Chart This with Dave Keller. I want to thank you guys so much for your thoughtful comments and your feedback. Very much appreciate how much you're engaging during the show, adding questions, putting comments in there, smashing the like button, as my son Henry asked me to tell you earlier this week. I can't tell you how much I appreciate it. It's a lot of fun, sort of growing Market Misbehavior and reaching out to new investors and some seasoned ones as well. And if my work helps you navigate these markets in some small or large way, I find a lot of joy in that. Have a fantastic weekend. And here from Market Misbehavior in Redmond, Washington, remember, it's always a good time to own good charts. Go Bucks. Have a good weekend.